Did you know the AI models we use today, the ones that write, reason, summarize, and increasingly advise us, are distant descendants of what's called neural networks? A concept of teaching machines to learn from data rather than programming them with precise rules. You see, in 1980s, while most of the world hadn't yet heard the term, Japan was already betting heavily on the idea of intelligent machines. The Japanese government had launched a national initiative to build thinking computers. The initiative was called the Fifth Generation Computer Systems. This is way back in 1982. Yes, they were that ahead. And in line with the government's program, engineers from various Japanese corporations were putting neural networks to work. First to control robots, then to do things far more ambitious. Around the same time, a team of researchers at Fujitsu Laboratories, led by Takashi Kimoto and Kazuo Asakawa, partnered with investment researchers at Nikko Securities, one of Japan's largest brokerages at that time, to answer a simple question: can a machine learn when to buy and when to sell stocks? So they built a system that fed on interest rates, foreign exchange rates, trading volumes, and even New York Dow Jones average data. Several neural networks learned the patterns, and then they ran the simulation. Over 33 months, from January 1987 to September 1989, the system ended at 1.98 against a simple buy and hold return of 1.67. The machine had indeed outperformed, though by a small margin. AI wasn't even a term then. The word doesn't even appear once in their published paper. It was just engineers and bankers trying something unusual, filing it quietly in the proceedings of an academic conference and moving on. Fast forward to today, and AI is everywhere. It's in your phone, your email, your search results, and if you're anything like me, you become that person who keeps bringing it up at dinner tables and WhatsApp groups with friends who are probably tired of hearing about it. So much so that my 80-year-old father, who has watched markets go through more cycles than most of us have, sat me down one evening and asked me, "You keep talking about this AI, can it actually predict the stock market?" And then he added, "And if it can, will your job become irrelevant?" I laughed while deep inside I was actually worried. Anyways, I told him not to worry and that I still have a few good years left before the machines replace me. But you see, the question stayed with me though. I told him, give me a month and I will find out and tell you if AI can predict stock markets. So I decided to find out by building a prediction system myself, using 4 of today's most capable AI models. That is exactly what this episode is all about. I'm your host, Sandeep Rao, and the question is, can AI predict stock markets? First things first, a few basic things in terms of how we went about running this test. We picked 4 large language models, or LLMs, which is nothing but a technical term for the kind of AI that powers all the tools. LLMs are the models that can read, reason, and respond in plain, simple language. In our experiment, we had 2 from Anthropic, Claude Sonnet and Claude Opus, 1 from OpenAI, which is GPT, 1 from Google, which is Gemini. Every day, each of these models receive exactly the same brief. Think of it as an analyst's morning note, except it's built automatically by code locally rather than written by a human. We don't dump raw price data on the models. Instead, the local code pre-computes a report of sorts, or call it a structured brief. The LLM models take over from there. They score 4 factors and then they state a direction, they give a range, and declare a confidence level. But here's the interesting part. That brief, the prompt that all 4 models receive daily, was itself designed using LLMs. We started with Claude, drafted a framework, took it to GPT and Gemini for feedback, brought that feedback back to Claude and refined it further. The final version reflects inputs from all 3 AI families, with me making the final call. In other words, The AI helped design the exam it would then take every day. I'll let you decide how to feel about that. But here's how the daily input report to the LLM looks like. But the key point here is this. Every model gets the same information at the same time in the same format. The only difference is how each model reasons with it. So once the models receive their daily brief, here is what they are asked to do. Each model scores 4 factors: trend, momentum, volatility, and price structure. And based on that scoring, the models make 2 specific predictions. First, the direction. Will the Nifty 50 open higher or lower than the previous day's close? Simple binary up or down. Second is the gap size. That is, by roughly how much do we expect the index to move at open. Now, some of you may ask why this approach instead of just giving raw OHLC data every day to the LLMs. Well, the first thing is this approach helps us optimize token use. Second, this is one way to reduce noise in reasoning and make the output more comparable across the models. Also, we run the test twice. The first prediction happens at 3:15 in the afternoon, just before the market closes. At this point, the models only have domestic data, what happened in the Indian market that day, and the past context. This is a prediction that is actually actionable. If you wanted to take a position before the close, this is the one you would use. The second prediction happens the next day morning at 8:45, before the market opens. By this point, the brief includes overnight global context, what had happened in the US markets, S&P 500, all that, and where GIFT Nifty is trading. This prediction is obviously not tradable. The market is just about to open anyways, but we run it to answer a specific question. Does adding global overnight information actually improve accuracy? And if yes, by how much? So in all, 2 predictions, twice a day, 4 models each time. Direction and gap size is the output for both, and that's the setup. So now that we have a sense of what the models are actually predicting, let's look at the data for the past 1 month and see how those predictions actually are. Let's start with direction accuracy. Which of these models is best at predicting whether the Nifty will open higher or lower the next day? I'm going to focus only on direction in this video and not on the gap size, that is, how much the index moves. The reason is all 4 models have been pretty poor on that parameter. So there's not much to discuss there. What you see on the screen is a bar chart with 2 sets of bars for each of the models. The blue bars are the afternoon predictions, the one made at 3:15 just before the market closes. These are the ones that actually matter because they are the ones you can act on. The grey bars are the morning predictions made at 8:45 the next day, and while they are more accurate, they are essentially useless from a trading standpoint, but nonetheless a good academic exercise. The data covers 31 live trading days from 24th March to 12th of May 2026. On the afternoon predictions, Claude Opus 4.6 leads the pack with a direction accuracy of 62.9%. In simple terms, out of 31 trading days, it called the direction of the next day morning's open correctly about 19 times. That's not great, but it's a shade better than a coin toss, which would have given us 50%. Now, you'll also notice the grey bars are significantly higher. Morning accuracy ranges from 83% to 89% across all 4 models. And that's not surprising. By 8:45 in the morning, you already know what has happened in the US overnight and where GIFT Nifty is trading. Of course, that improves the accuracy. The next day's open is heavily influenced by what happened the previous night globally. The problem is we can't trade at 8:45, so we have to make that call the evening before with only domestic data in hand. That's exactly what makes the afternoon prediction harder and a more interesting problem to solve. Now let's take this a step further. Let's assume we knew Claude Opus was the best performer, which in hindsight we did, and we decide to track a hypothetical trade on Nifty spot based purely on this afternoon prediction. Long if it said up, short if it said down, enter at 3:15 close, exit at 9:15 open the next morning. The result? About 638 points in profit across 31 trades, a win rate of 61%, and a max drawdown of 548 points. The return to drawdown ratio isn't great, but the system is still in green. The problem is, this isn't realistic either. Getting filled at exact 9:15 open is impossible. So I went one step further and looked at the same trades on 1 minute data, exiting at the 9:16 open instead of 9:15. Just 1 minute after the first crazy candle settles. The difference, as you can see, is stark. Win rate drops from 61% to 55%. Total profit falls from about 90 points. And the max drawdown nearly doubles from 548 to over 1000 points. 1 minute of difference and the picture changes quite significantly. Interestingly, both long and short trades are profitable in the 1 minute test, which is actually an improvement over the 15-minute version where shorts were essentially flat. But the overall numbers are still weak. What this tells us is predicting direction is one thing. Turning that prediction into a tradable strategy with meaningful alpha is a completely different problem. Once you layer in realistic entry and exit conditions, let alone transaction costs, slippage and all of that, the edge can erode quickly. A bare bones prediction model can at best be a starting point in your research. So now, where does this leave us? And what comes next? A few important caveats before drawing any conclusions. 1. 30 days is too small a sample. And secondly, the past 30 trading days were far from ordinary. This was a news-driven, high volatility environment, tariff announcements, geopolitical uncertainty, sharp intraday swings. No model, AI or otherwise, is designed to predict what DJT would say or do next. The fact that the AI model stayed on the right side of zero in this environment is frankly quite encouraging. Now there are a few natural next steps from here. The first is the reasoning depth. In this experiment, we deliberately kept the models on a tight leash. Structured input, structured output, limited room for thinking aloud. Whether giving them more reasoning space improves accuracy is genuinely an open question, and one worth visiting. The second is benchmark comparison. Before you can claim an AI model adds value, you need to ask, does a simple mechanical rules-based model, something like a basic EMA-based strategy where you go long above the moving average and short below it, if such a dumb rule can match the results, you don't really need AI. You want the AI to do way better than that. And that's a test I will run later sometime. But stepping back, this whole exercise of using AI to predict the next day's open does feel promising, because the model does feel directionally useful. Perhaps it needs more refinement. And if you are a tech-oriented trader, building something like this is genuinely a great opportunity. Not for the predictions, but for the fact that it forces you to understand how these LLM models reason, where they fail, and how they can complement an existing process. The worst outcome here is that you may come away with a much clearer understanding of how LLMs think about the markets. That by itself is a great return on the investment. There's another thing that I want to highlight, and that's about how AI has been democratized. Today, you don't need a hedge fund, a quant team, or a Bloomberg terminal to run experiments like this. The same AI models that power this experiment are available to you for a few $1,000 a month. The data is accessible, and so are the other tools. What this experiment proves more than anything else is that a curious individual with a structured approach can now run tests that only institutional desks could afford a decade ago. And that is a remarkable shift, the one worth taking seriously. So that brings me to the end of this episode. I hope you found this episode useful. If you have any questions, feel free to drop them in the comments. I'll be happy to respond. Till then, take care and trade safe. I'll be back soon with the next one.